The Bank of Canada has decided to hold its key interest rate, citing stronger economic data more recently. My next guest believes it's too early to consider potential rate hikes. Let's go to BeiChen Lin, Senior Investment Strategist, Head of Canadian Strategy at Russell Investments. Thanks for your time.
No problem, Marilla. Happy to be here.
So the bank sees the rate of 2.25 as the right spot for basically both keeping inflation in check but supporting the economy. Do you agree?
So what happens is there's something in economics called a neutral rate of interest. It's a rate of interest that neither helps nor hinders economic activity. And usually economic models suggest that there can be a wide range as to where exactly that neutral rate of interest is. So the Bank of Canada's estimate is that the neutral rate of interest ranges anywhere between 2.25% to 3.25%. And generally speaking, we believe that that is an appropriate range for where the current neutral rate of interest is at the moment.
Okay, let's talk about where we are in the economy. We had some surprising strength in jobs. We had also a surprise with GDP growth. How would you characterize where we stand in the economy at the end of 2025?
So I think there were definitely some encouraging signs in the Canadian economy. We had 3 months of, at least on the headline numbers, stronger than expected Canadian job creation data. But when you dig a little bit deeper, you start to understand that the data might not be as strong as the initial headlines imply. So, for example, take the most recent month of job creation. Much of that job creation was driven by part-time employment rather than by full-time employment. It was driven by defensive sectors like healthcare and social assistance rather than more cyclical sectors. And we also had a decrease in what we call the participation rate. In other words, there were some people who decided not to look for jobs anymore. So that might have made the headline numbers look a little bit better than the economic situation might actually be. When we think about the trajectory for the Canadian economy, we are encouraged by how the Canadian economy has managed to withstand some of these trade tensions and other dynamics at play. Nevertheless, we think that there are still some ongoing cyclical risks that Canadian investors and consumers need to be mindful of going into 2026.
Okay, is much of the uncertainty for next year still wrapped up in trade?
I think trade plays into it. If you look at the business confidence surveys, you'll notice that a lot of businesses are a little bit hesitant to increase their capital expenditures at the moment. And the reason they're doing that is because they are citing ongoing uncertainty as it relates to the Canada-US-Mexico agreement negotiations. Now, our base case at Russell Investments is we do expect that ultimately a revised deal would be finalized, but we do think that the process of finalizing that trade deal might be a little bit bumpy.
Okay. When you look at the TSX versus the American markets, what is your take on how well they have done this year?
So both the TSX and the S&P 500 were up double digits this year, so it's been a really strong year. But when you look at the valuation differential, what you're seeing is that on a forward P multiple basis, you're still seeing a significant discount between where the TSX is trading versus where the S&P 500 is trading. And when we think about the investment landscape, we consider both the valuation and the cyclical factors. So at Russell Investments, our base case is that the Canadian economy in 2026 might still be under more pressure than the U.S. economy, where we're expecting strong growth. However, when you think about the valuation differential, we think that that valuation gap between Canadian stocks versus U.S. stocks offsets some of those cyclical factors. And that's why, from an asset allocation perspective, we're pretty neutral on the decision of allocating to Canadian stocks versus to U.S. stocks.
Okay. Do you think the rate cut in the U.S., as announced today, will be a stimulative force in the U.S.?
So our estimate is that the neutral rate of interest in the U.S. is somewhere around 3.25%. With today's decision by the Fed, we see interest rates having come down to about 3.6%. So still a little bit above our estimate of neutral, but not materially different. The bottom line is, as we look ahead to 2026, we are in a world where interest rates now are no longer at their peak. We are in a world where interest rates are no longer in restrictive territory, but because interest rates haven't moved below neutral, we don't expect that interest rates will be significantly stimulating the economy per se either. Now, that being said, we are still, generally speaking, optimistic on the U.S. outlook for a couple of reasons. One is we're seeing growing adoption of AI, and we expect that as we continue into 2026, that growth in adoption of AI is going to have benefits onto productivity, and that's likely going to help boost corporate profit margins. A second factor is as we move away from some of the initial trade volatility that we saw early into 2025, as we move into 2026, we're likely going to start to see some of the positive impacts from some of those fiscal developments like the Big Beautiful Bill Act in the United States. So we are generally optimistic about the U.S. economic outlook going forward.
Okay. Are there lingering concerns for them? We know that much of it had to do with the weakness they've been seeing in the job markets. But if you're looking at concerns or overhangs for the U.S. next year, what would it be?
So broadly speaking, we are generally optimistic on the U.S. outlook. However, that being said, we can't rule out the possibility of all risks. And one particular data point we are keeping on our eyes on is the labor market. So at the moment, what we've seen is we've seen a cooling in job creation. We've seen an orderly reduction in the amount of jobs that are added to the U.S. economy each month. Our base case is that the U.S. labor market will stabilize at around these levels. But there is always the risk that the labor market might slow more than expected. And if that were to happen, what you might see is that consumers have to cut back on spending, and it can potentially create a loop whereby you could see a deeper economic slowdown. That's not our base case, but it is something that we are watching closely.
All right. BeiChen Lin, I've got to leave it there, sir. Thanks for joining us. BeiChen Lin, Senior Investment Strategist, Head of Canadian Strategy at Russell Investments.